Before New York had Wall Street, before London had the city, there was Amsterdam, a small, windswept patch of land wrestled from the sea that quietly invented the operating system of the modern world. Stocks, banks, insurance, speculation, even the first financial crash. All of it emerged from a city built below sea level, protected by dikes and driven by necessity. 400 years ago, Amsterdam was an anomaly, a stubborn little republic in a continent ruled by kings. It had no crowned monarch, no sprawling land empire, no vast deposits of silver or gold. The Dutch had no Peruvian mines, no Indian Raj, no armies that could intimidate Spain or France on the battlefield. On paper, they were outmatched, but they possessed something more powerful than gold or gunpowder: trust. The Netherlands was a country stitched together by merchants and sailors, not aristocrats. They didn't conquer land, they conquered distance. They drained swamps, dug canals, mapped coastlines, and turned trade itself into a kind of technology. Every ship that left Amsterdam carried more than spices and textiles. It carried contracts, insurance policies, bills of exchange, and letters of credit, promises written on paper that could be redeemed thousands of miles away. Those documents were more than ink. They were portable trust, agreements that strangers believed in strongly enough to stake their livelihoods on. And that's where capitalism truly began, not as a lofty theory or a political manifesto, but as a practical solution to a basic problem. How do you pay for an adventure so dangerous and expensive that no single person can afford to take the risk? In 1602, a group of Dutch merchants came up with an answer that would change the world. They created the Verenigde Oostindische Compagnie, the Dutch East India Company, the world's first joint stock corporation in the modern sense. Before this, overseas trade expeditions were like highly organized gambling trips. A handful of wealthy backers would pool money to send one ship on one voyage. The ship left, hopefully came back. Everyone settled the accounts, and that was the end of the story. If it returned loaded with pepper and porcelain, investors cashed in. If it disappeared in a storm or was taken by pirates, the investors were ruined. Trade was episodic, risk was total. The Dutch East India Company rewrote those rules. Instead of dissolving after each voyage, the company became permanent. It raised a large pool of capital that stayed in the business. Investors bought shares, tiny slices of ownership, that represented a claim on the company's future earnings. And crucially, those shares could be sold to someone else at any time. Trade stopped being a one-off bet and turned into something fluid. You no longer had to sail to Asia or even see a ship to participate. You could buy a piece of the venture while standing safely on a quay in Amsterdam, miles from the ocean. For the first time in human history, wealth could be detached from work and from physical presence. Ownership became an abstract, tradable object. Armed with this new structure, the company raised astonishing sums, the rough equivalent of billions today, and built a commercial empire stretching from the Cape of Good Hope to the shores of Japan. It established forts, negotiated treaties, minted coins, and fielded private armies. In some regions, it behaved less like a business and more like a state. But the real revolution wasn't the empire itself. It was the market that formed around it. Those little pieces of ownership, the shares, did not just sit in drawers. They moved. Their prices rose and fell. News from Batavia or Ceylon could make or break fortunes in Amsterdam. A rumor about a lost fleet could send investors into a panic. Out of this constant motion came something entirely new, a permanent organized marketplace for securities. Every day, traders, investors, and gossip-hungry onlookers gathered on the Damrak near the Amsterdam Exchange to buy and sell those shares. Prices flickered with every ship's arrival and every scrap of information. It was noisy, chaotic, and often irrational. And it was the birth of the stock market. In the shadow of a church, under the bell towers and beside the canals, the modern world began to be priced in real time. The Dutch themselves didn't have a word like capitalism. They called it handel, commerce, trade, dealing. But the underlying logic was already in place: abstract ownership, transferable value, and a constant balancing act between greed and trust. While kings across Europe squeezed their subjects with new taxes to fund wars and palaces, Dutch merchants raised capital to fund voyages and warehouses. The difference sounds subtle, but it was profound. Taxes rely on obedience and authority. Capital relies on belief and expectation. Authority has borders. Belief can cross oceans. The 17th century became the Dutch Golden Age. Amsterdam turned into the richest, busiest city on earth. Its harbor forest was masts and rigging. Its warehouses overflowed with sugar, silks, spices, coffee, furs, and silver. Painters like Rembrandt and Vermeer documented a society that, for the first time, treated middle-class life as worthy of art. But the city's greatest treasure wasn't stacked in crates. It was invisible, numbers in ledgers written in careful script. Merchants traded not with sacks of coins, but with credit balances and promises to pay. They trusted paper more than the decrees of kings. Managing this increasingly complex web of obligations demanded something new. In 1609, Amsterdam created an institution that would become a prototype for the future, the Bank of Amsterdam. It was, in many ways, the first true central bank. Before it existed, Europe's money system was a mess. Every city, every principality seemed to mint its own coins. Many were debased, shaved around the edges, or outright forged. Counting money meant not just arithmetic, but metallurgy. The Bank of Amsterdam cut through that chaos. You could deposit your motley pile of coins, have them weighed and verified, and receive credit in the bank's books, a standardized, trusted unit of account known as bank money. That ledger money quickly became more reliable than actual coins. It was stable, predictable, and widely accepted. A merchant in Hamburg or Venice could trust a balance held at the Bank of Amsterdam more than coins stamped with a local prince's face. That trust allowed Amsterdam to scale trade beyond anything the world had seen. The bank became a safe haven for capital. Merchants across Europe opened accounts. Governments borrowed from it. Its balances circulated like an early form of digital currency, intangible yet indispensable, valuable because everyone agreed they were. The idea was radical. Confidence could substitute for metal. Belief in an institution could be more powerful than a chest of silver. That concept sits at the core of every modern financial system. With this framework in place, the Dutch advanced to the next level. They didn't just trade goods, they began to trade risk. They developed insurance contracts to cover losses at sea. They experimented with forward contracts that locked in prices for future deliveries. They created early versions of options that allowed traders to bet on whether prices would rise or fall. In the taverns, counting houses, and coffee rooms of Amsterdam, speculation evolved from an occasional side bet into a full-time profession. And it was intoxicating. A new class of traders discovered that they could profit not from cargoes themselves, but from changes in expectations about those cargoes. They wagered on routes, seasons, currencies, and storms. They built fortunes on volatility, and, inevitably, they lost fortunes to it. Because the same brilliance that gave birth to capitalism also produced its first great illusion, that wealth could expand without limit, as long as prices kept going up. In the 1630s, that illusion crystallized around a single, fragile object, a flower. Tulips. Imported from the Ottoman Empire, tulips became the status symbol of the Dutch elite. Their vivid colors and unusual patterns made them exotic, almost magical, in a gray northern landscape. Rare varieties, especially those with streaked or broken petals, sold for astonishing sums. Soon, contracts for bulbs that were still in the ground, unbloomed and unseen, began trading like stocks. Tulip mania took hold. At its peak, a single prize bulb could be worth as much as a house on one of Amsterdam's canals. Artisans, merchants, and nobles all joined the frenzy. People weren't buying flowers anymore. They were buying the expectation that someone else would pay even more tomorrow. And then one day, someone didn't. A few buyers failed to show up. Confidence cracked, prices slipped, then plunged. The market collapsed in a cascade of fear and forced sales. Fortunes evaporated overnight. People who had believed themselves rich woke up bankrupt. In that moment, Amsterdam, the city that had invented the modern economy, also invented the modern crash. Yet, even in ruin, there was progress. The Dutch did not outlaw speculation or shut down the markets. Instead, they studied what had happened. They argued, wrote pamphlets, adjusted rules, and slowly folded the lessons into their financial culture. The conclusion was harsh but invaluable. Markets are powered by human emotion, at least as much as by arithmetic. Fear and greed, hope and anxiety, drive prices in ways that no formula can fully anticipate. Emotion, like the sea surrounding Amsterdam, can never be perfectly contained behind neat walls. Out of this hard lesson, modern capitalism emerged not as a flawless engine, but as a self-correcting organism. It would lurch between excess and restraint, boom and bust, always trying to improve its defenses without ever quite taming its own impulses. Because what Amsterdam created was more than a handful of institutions, it was a mindset. The belief that commerce could replace conquest, that paper could outlast metal, and that trust itself could be engineered. The merchants of Amsterdam did not set out to reshape the global order. They were trying, above all, to make dangerous trade routes a little safer and a little more profitable. But in the process, they stumbled onto something far more explosive: the realization that the pursuit of security can generate infinite new forms of risk. 4 centuries later, we still live inside the system they improvised. By the late 1600s, Amsterdam had built something the world had never seen: an economy powered more by ideas, contracts, and expectations than by raw land or royal decree. It was a financial superpower without a traditional empire, and power, predictably, followed the money. Amsterdam became Europe's banker. Monarchs who had once sneered at Dutch shopkeepers found themselves borrowing from them. Spanish kings financed wars with Dutch credit. French merchants routed trade through Dutch intermediaries. Even England, which would later claim dominion over the seas, relied on Amsterdam's markets to fund its navy and its national debt. In less than a century, the Dutch had quietly inverted the old world order. Where empires once conquered with swords, the Dutch conquered with spreadsheets and ledgers. Their ships delivered spices and tea, but their institutions exported something more durable: the blueprint for global capitalism. Every principle we now take for granted, liquidity, transparency, risk-sharing, speculation, diversification, was shaped and refined along Amsterdam's canals. The bourse, the stock exchange, became the prototype of every modern trading floor. The VOC became the template for multinational corporations. The Bank of Amsterdam became the reference point for central banks from London to New York. But while the Dutch invented the system, they weren't the ones who ultimately scaled it to its largest form. Across the English Channel, another nation watched closely. By the late 17th century, England was exhausted by wars, plagued by debt, and searching for financial stability. Its rulers looked at Amsterdam's success and saw not just envy, but a roadmap. In 1694, the English crown effectively copied the Dutch model. It chartered the Bank of England, authorized it to issue notes backed by government debt, and in doing so, created a national bond market. The state could now borrow at scale by selling promises to pay future interest. Investors got a safe, liquid asset. The government got long-term funding. It was a Dutch idea with English branding. From that imitation grew the next financial empire. By the 1700s, London had begun to supplant Amsterdam as Europe's main financial hub. It evolved into a city of merchants, financiers, insurers, and brokers, rather than only courtiers and soldiers. Debt became a weapon. Britain used credit to build a navy, acquire colonies, and ultimately fuel the Industrial Revolution. The logic of balance sheets replaced the logic of battlefield glory. Capitalism had gone imperial. But embedded inside that success was a recurring paradox. Every empire that masters credit eventually risks drowning in it. Amsterdam was no exception. As the 18th century wore on, the Dutch Republic began to stagnate. The same financial system that had made it incredibly rich made it comfortable, then complacent. Capital piled up in safe, predictable instruments: loans, annuities, foreign bonds, instead of flowing into new ships, new technologies, or new industries. The economy grew top-heavy, like a ship carrying too much cargo on its upper decks. Dutch bankers lent money abroad, to the British Crown, to French enterprises, even to the young United States, rather than investing at home. Amsterdam shifted from being the engine of trade to being a rentier capital, living off interest payments instead of innovation. By the late 1700s, its relative power was already fading. Political turmoil and war only accelerated the decline. Napoleon's armies eventually marched in. The Dutch Republic fell. Its golden age was over. But its great invention, The financial system built on trust, credit, and abstract value survived and spread. Because once you create a system that runs on belief, you no longer need to dominate territories yourself. You only need others to keep believing in the system. And they did. When Amsterdam lost its primacy, London absorbed its methods. When London began to decline, New York inherited them. Wall Street's stock exchange was a direct descendant of the trading floors on the Damrak. The Federal Reserve carries conceptual DNA from the Bank of Amsterdam. Our global economy, from complex derivatives to intangible digital currencies, is an echo of that 17th century experiment in institutionalized trust. Even the mistakes echo. Tulip Mania, once mocked as a bizarre footnote, now looks like the prototype for every speculative bubble that followed. The South Sea bubble of 1720, the roaring stock market of the 1920s and the Great Depression, the dot-com boom of the late 1990s, the housing bubble and the crash of 2008, the cryptocurrency frenzy and collapses of the 2010s and 2020s. The assets change: flowers, company shares, mortgages, tokens. But the script remains familiar. Hype outruns reality. Leverage outruns caution. Optimism outruns truth. And each crash, instead of killing capitalism, ends up refining it. That's what makes Amsterdam's creation so durable and so dangerous. It isn't a fixed machine you can switch off and repair. It's a living system. It digests its own failures. It monetizes its own crises. Every meltdown leads to new regulations, new products, new narratives that promise to prevent the last disaster and, unintentionally, pave the way for the next one. The system is not built to eliminate bubbles. It is built to survive them. But beneath the graphs and balance sheets, there is a deeper layer, the human one. When the Dutch turned commerce into culture, they rewired moral expectations. In medieval Europe, charging interest was often condemned as usury. Profit-seeking was suspicious. Speculation bordered on heresy. Wealth was supposed to come from land, not from clever contracts. The Dutch flipped that script. They made profit respectable, even patriotic. Thrift, discipline, calculation, reinvestment, these became civic virtues. Religious ideas about calling and diligence merged with commercial practice. The Protestant ethic fused with the capitalist spirit, creating a worldview in which being hardworking, efficient, and solvent was not just prudent, it was moral. From that fusion came our modern idea of success, not merely surviving, but accumulating. Growth, expansion, and a rising balance sheet became proof of virtue and competence. It's easy to forget that the stock market began, in part, as a moral experiment. The Dutch believed that by pooling capital and spreading risk, they were creating a fairer system, one in which small investors could share in profits that used to belong only to kings, nobles, or a handful of great merchants. In that sense, it felt democratic. But democracy in finance is fragile. The more people participate, the more emotion enters the system. And emotion is volatility. That's why capitalism never stays calm for very long. It rests on the same paradox the Dutch faced 4 centuries ago. The more stable a system appears, the more hidden risk it must accumulate to keep growing at the same pace. That's why Amsterdam's story isn't just a piece of economic history. It's a warning, almost a prophecy. Every financial center that rose after it, London, New York, Hong Kong, Singapore, followed a similar arc. Innovation, expansion, sophistication, speculation, stagnation, crisis. The instruments get more complex, the software gets faster, the psychology barely changes. Each generation insists it has learned from the past. Each generation discovers, painfully, that it hasn't learned enough. In the end, capitalism is not really about money, it's about narrative. It is built on the story that tomorrow's trade will be bigger than today's, that a piece of paper or a line of code represents real value, that risk can be sliced, packaged, and controlled, that growth can be infinite on a finite planet. Those stories were first told in the warehouses, counting houses, and exchanges of 17th century Amsterdam. We have been repeating them ever since. But beneath all the charts and contracts, the Dutch left a quieter warning etched into the city's physical design. They knew the sea was never truly defeated, only managed. They built dikes, locks, and sluices not because the water would vanish, but because it was always waiting. They treated finance the same way. They built rules, checks, and institutions to contain the tides of greed and panic. They understood that the water, human emotion, and collective belief would keep rising and falling no matter what. And they knew something else. When the tide rises high enough, even the strongest walls eventually crack. Today, the tides have risen again. Global debt stands at record levels. Markets swing on rumors, algorithms, and speculative momentum rather than on productivity alone. Digital currencies and synthetic assets float almost entirely on faith. The tools are new. The story is old. The system that was created to manage risk has become, once again, one of the greatest risks we face. Because capitalism, at its core, is not a neutral machine humming in the background. It is a mirror reflecting our ambition, our fear, our hunger for security, and our appetite for more. Amsterdam was the first city to hold that mirror up to the world. 4 centuries later, we're still staring into it, still trying to convince ourselves that we can command the tides without getting our feet wet. Capitalism was not born in a boardroom or drafted as a manifesto. It emerged from the mud and marshes of a small republic that refused to drown. A system improvised out of necessity, powered by belief, scaled through trust in paper and ledgers. It made our modern world possible, and it leaves us with a question the Dutch themselves understood all too well. Any system built on trust eventually faces the same test. Does it still deserve it?